Leverage, the third component of wealth. Number 0. 3 facts you need to understand the importance of leverage. So far, we've learned about 2 components of wealth: liquidity and credit. In this article, we will learn about the third component, leverage. Don't forget that the reason we are learning in detail about the components of wealth is to develop the ability to choose the right means to reach the destination of wealth. In a previous study material, we defined wealth as the state of being able to consistently have what you want when you want it. The concept of leverage is critical to maintaining and growing this wealth. We define leverage as a wealth accumulation structure that can significantly increase the size of expected profits by acquiring the additional resources needed to compete at relatively little cost. For example, hiring mercenaries in a war is leverage. It takes an enormous amount of time and effort for a country to build its own military. By acquiring mercenaries at a relatively small cost, you can greatly increase your military resources to engage in the competition of war, and the military gains that can be expected can be very large. The act of hiring mercenaries fits the definition of leverage exactly. Franchising a business is also leverage. It takes a lot of time and effort to run a restaurant myself. However, if I manualize how to run a restaurant and share it with others, so that I can get a lot of people and shops to work for me, I can expect to make a lot more money than I would if I had to put in the effort to run just one restaurant. The act of investing by borrowing money at a lower interest rate than the expected return on investment is also leverage. If you invest with only your own money and earn a 20% return, your return on equity is calculated as 20%. If you borrowed half of the money to invest at a 5% interest rate and made the same investment, your return on equity would rise to 35%. If you borrow 75% of the money to invest, your return on equity jumps to a whopping 65%. This is a classic example of leverage. Of course, this leveraged strategy isn't all good. It has the potential to make you a huge profit, but it also has the potential to make you a huge loss if it fails. Because of this, many people are intimidated by the idea of using this leveraged strategy and shy away from it, preventing them from building wealth to their satisfaction. However, leverage is not an option. It's a necessity if you want to take your wealth to the next level. All the richest people we know utilize this leverage strategy. Why is this seemingly risky leverage essential to wealth? When you understand the 3 facts below, one after the other, you'll naturally realize why leverage is essential to wealth. The first is that the long-term return on investment required to become rich is much greater than many people think. Many people think that they can become rich by living frugally and saving money, or by investing in safe assets that slightly exceed the average inflation rate. But this is not true. Second, high returns are required, but high returns are always accompanied by high risks. The shorter the investment period, the stronger the correlation between return and risk. Many people believe that if they study hard about the investment target, they can achieve high returns without risk. However, this is not true. If you understand the concept of a perfectly competitive market, you will understand that high returns inevitably come with high risks. Third, once you know how to win in a complex system and how to operate leverage reliably over the long term, you can achieve high long-term investment returns with low risk. Only those who understand these 3 things will outrun the rest of the pack and punch the few tickets to wealth. Those who fail to use leverage don't get the ticket and lose their chance to reach wealth. Let's look at each of these 3 facts one by one. I'll use stock investing as an example, because I know many of my readers are interested in investing in stocks. But I want you to understand that they apply in any area. Number 1, the return on investment required to be wealthy is much higher than you think. Many people believe that they can get rich by being frugal, saving and investing safely without leverage. But that's a strategy with a very low probability of getting rich. We can't get wealthy unless we competitively pursue a higher rate of return on our investments than others. To understand this, we need a good understanding of inflation. I'm not simply saying that. You should prepare for rising prices over the long term, so please read carefully. How are prices determined? Prices are determined by money supply, x money circulation velocity output. The money supply is the total amount of money in circulation in the economy. The money circulation velocity is the number of times a unit of money is actually used to purchase goods or services in a given period of time. This money supply, x money circulation. Velocity is what we refer to as demand. Since the money circulation velocity is usually 1 or 2, and doesn't change much in the long run. Long-term growth in demand is primarily determined by growth in the money supply. On the other hand, output is the total amount of a good or service produced and put on the market. Why do prices, which are calculated as money supply x money circulation velocity, output, seem to go up inexorably? There are a number of reasons, but we'll cover the most fundamental ones. First of all, the variable money supply is determined by social consensus. If today's volume is $100, it could easily grow to $1,000 tomorrow, if there is a social consensus to do so. In particular, this social consensus of money supply has a bias. It's that everyone basically favors the direction in which money supply increases. Everyone likes a government that makes borrowing easier than a government that makes it harder. But the variable called output is different. If there's a shortage of housing, there can't be more housing tomorrow. If there's a shortage of crude oil, there can't be more crude oil tomorrow. No matter how many people want to get into Harvard University, it can't increase its capacity at a moment's notice. Prices will continue to rise over the long term because of the amount of money that can increase at will by social consensus versus the amount of output that cannot increase significantly due to real-world constraints. The important point to understand here is that the more limited a good or service is in production, the more steeply prices rise. For example, digital music is very cheap, no matter how popular a song is around the world. This is because digital music can be copied infinitely and is instantly available to anyone who wants it. Real estate, on the other hand, is different. If someone else has bought the property I want, it becomes very difficult for me to get the same property. I can only buy it if the person who already bought it sells it, and of course, they will sell it for more than they paid for it. In other words, the more limited the supply of a good or service, the steeper the price rise, and the key to consuming it is to gain purchasing power faster than others. For example, let's say you make $100,000 a year, you have a 20% savings rate. The long-term average U.S. savings rate is about 7%, so you're a very frugal person. Compared to the average, and your wages and consumption grow at an average of 3% a year. How long will it take you to buy a $2 million home, which is considered a pretty high-end home in the U.S.? A $2 million home is a scarce commodity, as we explained earlier, so it will rise in price faster than the average consumer price inflation rate of 2–3%. Let's assume that housing appreciates at an average of 5% per year. First, let's look at what would happen if you invested your savings in a 3% yielding savings account. You won't be able to buy this house in your lifetime. In the first year, when you saved about $20,000, the house appreciated by $100,000. Jumping ahead to year 10, when you added about $30,000 in equity over the year, the property is up about $150,000 over the year. So real estate is running away from you at a rate you can't keep up with. So let's calculate backwards the return on investment. You would need to buy this property in 10 years. What would it be? The average annualized return on investment required is a whopping 56%. For reference, the world's most famous investors, Warren Buffett, Benjamin Graham, George Soros, and others, have long-term average annualized returns of 20 to 30%. You'd need to maintain a 56% average annualized return for 10 years to catch up to a house that appreciated to about $3 million in year 10. So the return on investment required to get from a middle income to a top-tier home is much higher than you might think. It's not something you can do by saving and investing conservatively. You should remember that what you want when you become rich is usually something scarce that is not produced in sufficient quantities, and that other people want to have. The average inflation rate for the entire country is not very important. What matters is the inflation rate for the goods or services you want to buy. The scarce things are already flying high and they're going up faster. If I fly slowly, I'll never catch them. It's only when I fly faster than everyone else that I have a chance of catching them. Number 2, high rates of return always come with high risks. You've probably realized that the rate of return required to achieve wealth is much higher than you think. We need to achieve a rate of return that even the masters of investing couldn't. Is this possible? Unfortunately, it's not possible without leverage. There are limits to the rate of return that can be earned on equity alone without leverage. Even the world's most famous investment masters, in most cases, have long-term average annualized returns of no more than 30% per year. Why is this the case? Because high investment returns necessarily come with high risk. While you might get lucky once or twice and earn a high rate of return in the short term, it's highly unlikely that you'll be able to sustain that rate of return over the long term. There's a de facto limit to the rate of return you can sustain over the long term. Many people instinctively ignore this fact, so they study their favorite stocks and think, I know more about this than anyone else, so how can I fail? This happens because we lack the concept of a perfectly competitive market. A perfectly competitive market is a theoretical ideal that cannot exist in reality. It has the following conditions. First, there are enough buyers and sellers. There is no situation in which only one seller determines the market price, or only one buyer determines the market price. Since there are enough sellers and buyers, the impact of a particular buyer or seller on the market price is almost non-existent. Second, the goods or services offered by all sellers are identical, so buyers make a choice based solely on price. Third, all participants in the market have complete information about prices, quality of goods, terms of trade, etc., in real time. Fourth, this market is easy for anyone to enter and exit. Anyone can produce and sell goods if they want, and anyone can sell their business and leave the market if they want. Fifth, individual buyers and sellers accept the price they are given. They have neither the ability nor the will to adjust the price themselves. Sixth, there are no transaction costs involved in trading goods or services. What does a market that fulfills these 6 conditions look like? Let's imagine what a perfectly competitive market for hamburgers would look like. Let's say the price of a hamburger is currently $10. If this market is perfectly competitive, there is no way I can buy a hamburger for less than $10. Because all market participants have homogeneous information, no matter how much I explain that this hamburger is actually worth $8, there is not a single seller willing to sell it to me for $8. Now, what if the stock market was a perfectly competitive market? There's no way I can buy a stock that everyone thinks is worth $10 for $8. Because everyone in the transaction has homogeneous information, there's not a single seller who would sell a stock that's truly worth $10 for $8. If the stock market were a perfectly competitive market, it would be very difficult for us to buy a stock at a price below its fair value and earn a high rate of return. So is the stock market close to a perfectly competitive market? Is it more like a perfect monopoly, the opposite of a perfectly competitive market? A perfect monopoly is the opposite of the 6 conditions of a perfectly competitive market described above. A classic example is government monopolized water services. The government is the sole seller and can determine both output and price. Where does the stock market come close? The stock market is not a perfectly competitive market, because a 100% perfectly competitive market is unlikely to exist in the real world, but it is much closer to a perfectly competitive market than a monopolistic market for several reasons. For starters, the proportion of long-term outperformers in the stock market is very small. If the stock market were far from perfect competition, the better informed and better funded would have to consistently outperform. However, as I mentioned in my previous study material, even fund managers on Wall Street, an elite group, have had a fairly poor track record of long-term investment performance. In the last decade, less than 20% of all large-cap funds in the US have outperformed the S&P 500 index. The quality of information available to market participants is becoming more similar due to the development of media and stock trading. Using insider information is increasingly prohibited by law, so the information gap between market participants is shrinking. There are stock trading costs, but they are not as high as they used to be. And now, if someone living in Asia opens a stock account, they can invest in the US stock market with low trading costs. And since it is becoming easier for anyone to obtain the information, they need to invest in stocks. The cost of time spent on the trading process is also decreasing. In many ways, the stock market is not a 100% perfectly competitive market, but it has similar characteristics to a perfectly competitive market. That's not to say it's impossible to earn excess returns, but it's not easy. To outperform the market by 1%, an individual needs to be only slightly smarter than the collective intelligence of stock market participants. To outperform the market return by 5%, an individual needs to be a lot smarter than the collective intelligence. To outperform the market return by 20%, an individual would have to be overwhelmingly smarter than the collective intelligence. And that intelligence would have to be world-class. To outperform the market return by 30% is simply not humanly possible. No one can be wiser than the collective intelligence by such a significant margin. The more you believe a stock is cheap relative to its fair value, and the more you believe it will quickly return to its fair value, the more likely you are to be wrong, because your judgment is the opposite of the current smart collective intelligence. In other words, high returns inevitably come with high risk. To chase high returns, you have to be overwhelmingly smarter than the collective intelligence, and that's usually not very likely. So we need leverage. As we explained in the introduction, even if your strategy can deliver a 20% average annualized return on equity, you can more than double your return on equity by borrowing. Leveraging is a much smarter approach than trying to do the impossible, like finding a strategy with a 40% average annualized return on equity. Number 3, how to win in a complex system and how to operate leverage reliably. If you have understood the content so far, you should understand that to climb the ladder of wealth, a higher return on equity is required than you might have thought. And that leverage is essential because there is a limit to the return on equity that can be achieved without leverage. But even for those who understand that leverage is essential, it's not always easy to choose. This is because leverage is a strategy that is too scary for most people. There is a clear possibility of great success when using leverage, but there is also a possibility of great failure. So before we use leverage, we need to learn how to invest in a way that will always succeed, and how to operate leverage reliably. We've already learned how to always succeed in investing. In the last article, we learned that there are 2 ways to win in the complex system of investing. The first is to observe and analyze long-term data to find the factors that are critical to investment success. And the second is to apply those factors and keep the strategy unchanged for at least 5 years. The first is important, but the second is actually more important. For example, consider the strategy of buying an S&P 500 ETF. An ETF is a fund that is listed and traded on the market, like a stock, and tracks the performance of the S&P 500 index. What you mean by investing in the S&P 500 ETF for the long term is that you want to be diversified across 500 representative large-cap stocks from each industry as selected by S&P. It's not a bad strategy, but it's not a great strategy because there are many more factors that play a role in investment success than just representative large-cap stocks from each industry. But even this mediocre strategy is less likely to fail if you extend your investment horizon to the long term. Data from 1972, when the gold standard was abolished, to the present shows that if you invested in the S&P 500 index for 3 months, there was a 33% chance of a negative annualized return. But if you invested for 15 years, the probability of a negative annualized return drops to 0%, regardless of when you started investing. Even for the simplest strategy of tracking the S&P 500 index return, exactly, increasing the investment horizon to 15 years significantly lowers the probability of losing money. Of course, if you take a more strategic approach, you can reduce the minimum investment period that makes the probability of loss to 0% to 5 years. Instead of simply buying the large-cap stocks that represent each industry, using a strategy that takes into account factors with a strong influence, such as valuation, price momentum, and shareholder returns, reduces the probability of failure to 0%, even with a 5-year investment. You'll learn about specific ways to implement these strategies in future study materials. Once you've learned how to make your investments have a 0% chance of failing over 5 years, there's only one challenge left. It is to maintain leverage stably for more than 5 years. This is more difficult than you might think. For example, what if you take out a loan and try to leverage it into an investment? But it's a 1-year loan. You need to invest for at least 5 years to have a 0% chance of losing money. And if your loan has a 1-year maturity, you won't be able to sustain your investment for 5 years. Or what if the principal and interest you need to repay exceeds your disposable income? You might not be able to make it through the 5-year minimum investment period and end up having to exit the investment along with paying off the loan. Or what if you invested all your money without leaving any for living expenses? When you have to move, suddenly, incur large medical expenses, spend a lot of money on a wedding, or have to replace your car due to unavoidable circumstances, you will stop investing. There are a lot of facts to consider when it comes to maintaining a leveraged strategy for 5 years or more with stability, so you need to learn how to eliminate the risk of loss when investing, as well as how to operate leverage stably for a long period of time. Number 4, a successful leverage strategy is a must. By now, you should understand 3 facts. The first is that those who want to take their wealth to the next level should expect a much higher return on investment than they might think due to inflationary factors. The second is that leverage is essential for achieving very high returns because there is only a limited amount of return that can be achieved with acceptable risk without leverage. The third is that recklessly leveraged strategies are very risky, so you need to learn strategies to reduce the probability of investment failure and strategies to operate leverage reliably. Once we understand these three facts, we can also understand that leverage is an essential component of wealth. Those who have built a wealth accumulation structure in the form of leverage maintain and easily increase their wealth. Those who have not are easily weakened in their purchasing power and lose their wealth because of those who have built leverage. Many wealthy people who understand these three facts are already using stable and powerful leverage strategies. Warren Buffett, who once said, "Investing with loans is like driving with a knife in the middle of the steering wheel," also utilizes very powerful leverage instruments called public companies and floats more on this concept in another study, Materials. Real estate tycoons in many countries also understand the concept of leverage, which is why they take out mortgages to invest in real estate. Even if they have cash, if those who understand leverage get rich first and drive up the price of a scarce good or service, those who don't understand it quickly become poorer, as their purchasing power is eroded by rising prices. If there is no way to reduce the possibility of investment failure to almost zero, and if there is no way to operate leverage stably, leverage would not be a necessary element in competition. However, since there are such methods and many people are already using them, leverage is an essential element to stay ahead of the competition. I hope this article has motivated you to learn how to significantly reduce your chances of investment failure and how to operate leverage reliably. In the next study material, we will learn about the final component of wealth, cash flow.